If you're watching this video, then you might be looking for a retrospective appraisal in order to reduce your capital gains tax that you owe in order to get a stepped up basis. If that doesn't make any sense at all, but you're trying to reduce your capital gains tax from a recent mineral sale, then you've still made it to the right place. Today we're going to go over what a retrospective appraisal is and when it works, when it doesn't, when you should consider it, and then a quick way that you can scope to see if it'd be worth it. My name is Tracy Lenz and I'm a petroleum engineer and owner of Pecan Tree Oil and Gas. I've been a petroleum engineer for over 15 years now, and now I focus exclusively on helping mineral owners and small interest owners in knowing what they own and getting the most out of their minerals. As a full disclosure, I do not buy, I do not sell. I am not part of that process at all. I am not affiliated with anyone who does buy or sell. I'm purely independent and third party and working straight for you only. Okay, so let's back up a little bit. If you're here, you likely, just based on the people that I normally talk to looking for a retrospective appraisal, you've probably either recently inherited minerals or recently sold or bought minerals. Now, if you've bought minerals recently, then unfortunately, this is not the video for you because retrospective appraisals don't apply if you've purchased minerals. And so if you're here because you bought them 10 years ago and you're trying to reset the cost to something higher, sorry, whatever you bought it for is the basis that you have to pay taxes on. Now, if you're here because you inherited minerals 10 years ago, let's keep watching. Now, you might have been told from a lawyer or your CPA that you need something called the cost basis for your minerals. The default, if you don't have any idea of what your minerals were worth when you inherited them, is zero. So if you sold them today for $100,000 and you inherited them a long time ago, but they were worth something when you inherited them, you only have to pay taxes on the increase between when you inherited the minerals and when you sold them. But if you have no way of showing what they were worth when you inherited them, then the assumption is they were worth nothing. Now, that means you would owe the full amount of taxes on that sale, which if you owned it longer than a year, as of right now, I'm not a CPA, I'm not an attorney, this is just an engineer giving free advice on the internet. I'm not your engineer, so just all those disclaimers aside. If you sold those today and you owned it for longer than a year, it's considered real estate property. So it's the same as if you sold a house. So if you owned it longer than a year, then it would be a long-term capital gains that you'd owe taxes on. Most people end up being in about the 15% tax bracket, but there is a higher tax bracket if you sold a large amount in that year. So just talk to your attorney or accountant on what tax bracket that's in. For today's purposes, we're just going to assume everybody's in the 15% range, just for simple math. Now, if you owned it less than a year, there's a short-term capital gains, which is treated a little differently. Again, talk to your CPA on what makes the most sense for you and what bracket you'll be in for these type of calculations. So let's say that you're in the category of people who inherited minerals, say from your mom or a cousin or an uncle or something. You inherited those minerals, and you do have some feel for what they were worth when you inherited. Maybe there was some probate or evaluation or something that happened on the day that you inherited them that gives you a feeling for how much they were worth at the time. It really depends on how clear and how well defined that value was at the time of inheritance on whether or not you can kind of override that with a more formal, more thorough evaluation. If you had an engineer go through and look at the value at the time, then there's very little we can do now because that is considered kind of gold standard. The IRS considers this a petroleum engineering topic as to what things were worth at the time. I'm sorry, all landmen and lawyers and accountants out there who put values on things. That is great. That works for a large number of properties. But there's also a large number of properties where you really have to know what's going on underneath the ground and all the different dynamics and all the things that go into valuing these properties and determining how much future production they will make, because that's what these values are based on, is future production. And then also how to discount that back to today's values in order to get that fair market value. And so if that thorough evaluation has been done already and you just think it was wrong, it has to be really wrong in order to override that. Like they would have had to use a completely wrong method, something that, someone like me could go and testify and say, hey, no, this was wrong. They should not have done this. This was completely inaccurate. Shame on them for even considering doing it this way, like that type of wrong, not just, well, their opinion ended up not being correct. Because this is a very speculative field. It's a very, there's a lot of risks, there's a lot of unknowns, things change day to day. I mean, you just think about early 2020. If I'd put a value on anything early 2020, and I did, I've been doing this for years, and I consider myself very good at this, but an early March 2020 value placed on minerals was completely wrong when you look at what happened in 2020. So if an engineer put a value in January of 2020 on your minerals, and then it was completely wrong because the world just turned upside down for the next year and a half and the market crashed and everything just completely changed, that engineer could not have known that was going to happen. That's not considered doing it incorrectly. That's just considered the future changing, and this is a prediction thing. So that type of wrongness does not apply in this scenario. So there will be situations where someone put a value on minerals at a certain date and time, and less than a year later, they were completely wrong. And that is totally okay in terms of what they decided it was on that day, because the future changes these projections. And when we do these retrospective evaluations, the appraisal has to be based on only the knowledge that was known at that time. So anything that happened after the date that you inherited it does not count towards the appraisal. I cannot go back and say, well, prices went down, you didn't make as much money, or reverse. I can't go back and say, well, they started drilling in your section and things went bonkers and all of a sudden it was worth a lot more just because things changed, because I wouldn't have known that on the date that you inherited it. And it has to be based on what you could have sold it on that day. Okay, so let's talk about another situation that would make it to where you could not get a retrospective evaluation. And honestly, I know I'm sounding like I'm talking you out of it, and I kind of am, because most people, this retrospective evaluation doesn't make sense for. And I'm hoping that if you're reaching out to me for one, that it makes sense, and I will scope this for you ahead of time, but it saves everybody time, saves you some headaches if you know ahead of time. Again, if you purchased it, we talked about that already. If you purchased it, then sorry, whatever you purchased it for is your basis. If it was gifted to you rather than inherited, say that your grandma gifted it to you 5 years before she died, that is a gift, and that is the cost basis is this rule, this little like trick of inheritance and stepped up basis does not apply. I can't tell you the details as to why, because I'm not a tax attorney. Maybe someone who is well versed in the tax code can put more details below on the differences between gifting and inheriting, but it is based on date of death of inheritance, and that is when you get it. And because of that special inheritance rule, you're allowed to step up the basis if that's how you acquire it. Again, gifting is essentially selling it to you, right? You bought it for $0. That's how gifts are more treated in the tax code. And I'm sure it's a lot more complicated than that. There's gift tax and all those things. But as far as this particular purpose, gifting is just like you bought it for $0, and it goes into a completely different category. So if you're looking to plan your estate, like transition to the next generation, keep that in mind. But don't gift it 2 years before you die. I mean, no one wants to plan when they die. No one plans when they die. But don't gift it just thinking that will be a help before you talk to a CPA or attorney or some type of financial planner that knows a lot about how this works, because it might be more beneficial to the next generation if they inherit it through a different outlet. I'm a big fan of putting it into a trust or LLC and having it flow through that way. The paperwork ends up being a lot better. You're taking care of the paperwork ahead of time rather than having people deal with the paperwork when they might be highly emotional or being overwhelmed with all the things that are coming their way. It's kind of prepaying for probate. It's getting all of that in order while you still know all the things about it and while you're still there to sign any papers that need to clean up the documents. So I'm a big fan of the LLC route. That still is considered an inheritance, even if it's not going from individual to individual. But again, that needs to be all passed through a person who is an expert in this, that's like an attorney or estate planner or something like that. And I'm not any of those. I get the feedback from everybody who's gone through people like that. So again, I'm just an engineer who does these evaluations and appraisals, and this is just what I've seen work. Okay, so a retrospective appraisal is called that because it's looking back into the past and evaluating what would have been the fair market value, which is the price you could sell it for or buy it for on the free market, what the market value was for those minerals back in time. Now, what date do you choose for that? Because it comes up quite a bit where someone inherited it but didn't know they inherited it. And then 10 years down the road, they were contacted and, oh, hey, you own this thing that you inherited 10 years ago. Which date did they use? The date that they found out that they inherited it? Long story short, it's the date that the person passed away that you got it from. It doesn't matter when the probate finished or when the documents were signed or any of those things afterwards, what date the landman contacted you, which date anything was filed, if there were any quitclaim deeds or affidavits of heirship, any of those things, those don't matter. What really matters is the date of death of the person that you inherited it from. Now, there's situations where you could probably use a different date. That gets beyond my scope, especially the scope for this video. And that's where you'd want to talk to your attorney or your accountant or whoever is referring you and helping you out with this type of thing. I'm hoping that you have help if you are looking at this type of appraisal and going through this type of more detailed tax evaluation, because nobody likes this type of thing. And there are experts who know a lot about it. And so it's just beneficial if you reach out to them. If they say that your date that you need to have your basis set on is a different date, then great. Just give me that date and that's what I'll go off of. But otherwise, it will be the date that the person you got it directly from passed away. So for the purpose of the scoping, we're going to take the maximum of all the different ways that we can slice this, because if it passes this threshold, then it's worth looking into a little further. So if you were going to pay $15,000 in taxes, then that means if the cost basis was also $100,000, say that the price didn't change at all from the time that you inherited it and you got kind of the maximum there, then you would save $15,000 by having a retrospective appraisal done. Now, from that, you'd need to subtract the cost of doing the actual report. So most firms, I would expect the minimum that you'd pay is somewhere in that $2,000 range. For scoping, let's just keep it simple and subtract $2,000 from that amount saved. So now you're at $13,000. So that's still a positive. That's still great. You would save $13,000 if those two conditions were met, right? Now, there's some things that make this not always the case. So there's some more scoping that we need to do. So the next thing is that the further away we are from the date that you inherited it, the more unknowns we're going to have to include into the equation. Now, unknowns when it comes to market value equal less value. People don't like paying for uncertainty, and uncertainty always reduces the amount that you're going to get. And then also, when you're doing this type of evaluation, if you don't know something, you kind of have to assume the worst, saying that, well, at a minimum, if I don't know this particular input, I'm going to assume it's the low versus the high. And so again, that's another way that you're reducing the fair market value. It's kind of like if you're buying a house and you don't know the last time the roof was replaced, you kind of assume that you're probably coming up on the next time the roof is going to be needed to be replaced. And you're going to budget that into how much you're going to pay for the house, at least in normal housing markets. I don't know what yours is like where you live, but let's assume we're not paying above market value for houses. If I knew the roof was replaced last year, well, then I have a whole different set of equations that I can use. Oh, I'm like, okay, the roof was replaced last year. That's reducing risk from my purchase price. I can up it just a little bit because I know that the next time I'm going to have to pay for that is down the road more. So that's how this works very similarly in oil and gas. The more things we know, the more things we're certain on, the higher the value. Now for scoping, since I'm not here to talk to you individually right now, we're just using rules of thumb, I'm going to give you these rules of thumb. If you inherited your property later than 2011, So between 2011 and now was the date of the person's passing that you now received the inheritance. Then we're going to consider this passing this scoping check. There was a lot of technology changes in the last 11 years or so that caused things to be worth completely different values after 2011 than before. So if you sold minerals, there's a high likelihood that you sold it in an area that was worth a lot more after 2011 than before, just statistically. So we're going to assume that if you inherited it before 2011, then the technology that made it worth a lot of money now wasn't developed yet, and we can't establish that in the retrospective appraisal. We can't use that technology. And so we'd have to assume that technology did not exist. For most people, that is the horizontal drilling in combination with the fracturing that unlocked these shales and economic volumes. That particular combination of technology was not being used until about after 2011 because that equation relied on your stepped-up basis being very close to or above even your sales value today. You're not going to be near that because the technology just didn't exist yet to make that worth money. And you probably realize that without knowing it because you weren't likely getting offers back in 2009 for these same minerals that you sold now. And if that's the case, if you weren't getting offers when you inherited the minerals, that is also a good kind of scoping of, well, this probably wasn't worth a lot back then, and now it is. So just because you inherited before 2011 doesn't mean that it's completely off the table, but there's some other things we need to consider. So let's say that in 2005, you were receiving a bunch of offers and you sold it for something very similar to what you were receiving back then. Then there's some other things we need to consider. So if the asset was producing, so after you inherited, if you've received royalty payments on anything that was producing, any wells, or if you've received checks in the mail for something from production, then that is what they call depleting your asset. And we're about to dive deep into the accounting waters, and I will hold your hand as we go through it. And I'm not an accountant, so we won't go much deeper than we're about to go. So that each year you get a tax deduction for depletion of your asset. And if you're doing TurboTax, it'll probably ask if you've gotten any royalty payments or something. And that's the DD&A, depreciation, and amortization. That is your depletion allowance that you're allowed to deduct. That it's saying, I had this thing worth this amount, and this amount has been reduced because it was produced. And like I had this tank of 100,000 barrels, and 10,000 barrels was taken out, and I received payments on it, and I paid taxes on that amount. And now my tank is worth less. And so that depletion, you get a deduction for that tank being worth less. And so that's what that depletion allowance is allowing you to do. And so typically most mineral owners do the easier deduction. And if you weren't doing any deductions like this, then it assumes that you were doing this deduction, because what the IRS says is, yeah, you can pay less in taxes because of that cost basis, but you're already receiving a tax break in there for depletion, so you get the tax break after the depletion thing is taken away. So we're going to just keep the numbers real simple. Your tax accountant hopefully knows a lot more about this than I do because, again, I am not a tax accountant. But find a good oil and gas one that knows what they're doing for this type of thing, and that should set you on a good pace. So in our example, we had $15,000 that we could save, right? We subtracted the $2,000 of the report, so we were down to $13,000. And now we have our hypothetical $10,000 of depletion allowance that we deducted from our taxes already. So now we're down to $3,000. So $3,000, we're still positive. So if you were to spend $2,000 to get this report done, you'd hypothetically save $3,000. You are starting to border into the place of there's some things that can happen that reduces that $3,000 to zero, and then you paid $2,000 to do nothing to your taxes, and it may not be worth it for you to do at all at that point. And so that's why I start limiting at 2011 or after. There's less production that you're likely to deduct from your depletion calculation, and then also the chances of that value being higher is also greater because we're closer to today's values. And you probably wouldn't have sold today if the value wasn't high today anyway. So, okay, so to quickly recap for the scoping, we have how much you sold it for times 15% or 0.15 minus $2,000 for the cost of a minimum cost of a report, and then take the year that you inherited it. If it's after 2011, green light, keep going. If it's after, for this, the next kind of like level, if it's after the year 2000, then it will really depend on the production calculation, and you can I'll talk you through that if you want to reach out to me, and we can work through if this makes sense again, if you reach to this part in the scoping and it's unknown still. And then if your year of inheritance was before the year 2000, it's really getting into some hairy things on trying to figure out what the wells were producing at the time, what the market was like at the time, what the pricing was, what the risk factors in the market. There's just a lot of unknowns that are just going to reduce that capital basis likely enough that it's not worth it unless certain conditions apply. So if you're still being advised to get this analysis after you've gone through all these things, and my scoping little exercise says not to, if you're still being advised to, just reach out to me. I'll do the scoping for free for you. There might be a special condition that is causing your advisor to ask you to do this. And I've seen the cases where that makes sense before. It's not unusual, but just know that after 2011 is typically where most of the people I see that get a benefit from this are. So that's probably way more than you wanted to know about this topic. It's way more tax than I ever thought I'd talk about on my channel, but hopefully this broke it down to a place where at least you can feel comfortable of what you're asking for, what you're getting. Again, Pecan Tree Oil and Gas helps mineral owners. We are an appraisal firm that is licensed in Texas, but can do appraisals all across the U.S. Our specialty is for properties that are based in the mid-continent, which is considered the middle of the U.S., so Texas up to North Dakota, and anywhere kind of in those states in there, New Mexico, Utah, Colorado, Oklahoma, that little channel. That's where we specialize. So if you're completely confused, reach out below. I'll walk you through this, and have a great day. Thanks.